Hello, and welcome to Week 2 of our Introduction 2020 Faculty Perspectives series. We're so glad you've joined us today. Each week we will present 5 live interdisciplinary faculty perspectives centered around 5 different tracks. Those tracks in order are COVID-19, anti-racism, environment and climate change, engaged humanities, and finally, innovation and entrepreneurship. In a minute, I will turn things over to today's presenter, who will present for about 30 minutes, and then we will have about 15 minutes to answer many of your questions live on camera. If you're a student watching live in Zoom, use the Q&A feature to ask questions of our presenter. We will also follow up after the program to any questions we don't answer live. At this time, I'm pleased to introduce you to Tim Dewey, Professor of Practice and Senior Director of the Oregon Economics Program for the Department of Economics. Professor Dewey is also the co-director of the undergraduate program for the department. Today he is going to present on the 3 Ds of depression and the economic outlook in the pandemic era. Welcome, Professor Dewey. How are you?
Very good. Thank you for having me.
Yes, thank you for being here. I'm going to let you take it away.
Okay, thank you very much. All right, well, thanks everyone for joining us. This is a presentation I've been calling the 3 Ds of depression, the economic outlook in the pandemic era. This is a sort of chopped down version of the kind of work I do a lot, which is a lot of outreach work, giving speeches, talking to the community. And we'll talk a little bit more about that a little bit deeper into the program. First, I want to give you a little bit of an idea of who I am and how I got to where I am. I do a number of different things for the university. This is an example of some of the work. Tim Dewey's FedWatch, which is the national economic analysis newsletter. The State of Oregon Economic Indicators, which is exactly what it says, looking at the local economy. And some work also as I've written. And then also, conferences, events, those sorts of things. That's a picture of me at the Brookings Institute. And in the far end of that seating is Ben Bernanke, who was chair of the Federal Reserve. A lot of my work covers monetary policy and fiscal policy. So, all right, well, there we go. All right, so here's how I'm going to present this. Background, essentially, how did I end up in this field? Some of the research I'm working on now, some of the outreach, how do I connect with the community, and then teaching. What do I do here how does my research inform the teaching that I do? So that's my plan for the next half hour. So my background. I'm a little bit unusual. I have my graduate degree, my PhD from the University of Oregon, and I left Oregon to work at the U.S. Treasury, and this was in the late 1990s. So I worked at the U.S. Treasury. I was an economist in the International Affairs Division, specifically with industrial nations. So a lot of the work I did there was forecasting the U.S. trade deficit, or at that point in time studying Japanese monetary policy. And so that was a period of time where we saw some of the research that actually has become very prevalent in the last 10 years, the research moving us toward what happens when an economy moves towards 0 interest rates. So I was able to experience that. Then I moved from the Treasury into the private sector, so I worked for an economic and financial consultancy called the G7 Group, and that's where I was able to learn a lot more about how monetary policy and financial markets interact. And so that position, I was fortunate enough to work under, at the time, Professor Alan Blinder, who was vice chair at the Federal Reserve under Alan Greenspan at one point, and then also as a professor at Princeton. So after that job, my wife and I decided to move back to the University of Oregon, and I've been fortunate enough to build a career here at the university. So what I like to think of as my research is really the intersection of economics, policy, and finance. So somewhere in how do I take what's going on in the research community and apply that to what's going on in the policy community, and then translate that what goes into the financial markets. So somewhere in that space is where I tend to operate, that nexus of events. My title is Professor of Practice, and what that means is essentially is someone who has had a lot of real-world experience that they're trying to bring into both the research and the classroom, and that's the space that I try to work in. So a lot of my work is actually tends to be directed toward financial markets in particular, particularly people that trade in, say, bonds in particular, things that basically depend upon what interest rates are going to do, which depends upon what monetary policy is going to do. So right now, it's extremely interesting time. So this is the intersection of not just monetary policy, but also fiscal policy. So this is a picture of Federal Reserve Chair Jay Powell, and then U.S. Treasury Secretary Steven Mnuchin, and they have had an incredible role over the last 3 or 4 months in shaping economic policy as we've dealt with the side effects of COVID-19. So how is this all applying? Well, I kind of have structured this topic around the idea that this is an extremely severe recession. When does it become a depression? And what kind of policies do we need to prevent it from becoming a depression? So I've called this the 3 Ds of depression, to think about, well, what's going to separate this from the last downturn versus the downturn before that? So these are very different types of downturns. Always defeated by the clicker. Thank you. So let's think about this in 3 terms: depth, duration, and deflation. So thinking about depth, this was a very unusual downturn. Typically, ahead of a recession, economists have a lot of time to really argue about whether a recession is actually going to occur. So if you think about the last recession, for example, so in 2005, 2006, we're able to start debating, well, what's the implication of the housing market downturn on the economy? Will the economy slide into recession? What policy should we take in now to try to prevent that recession? And we had similar discussions in 2000. We have this typically ahead of a recession. And the neat thing from a research perspective and an economist perspective is sort of debating how the data is unfolding, or what data points are important, what data points are not important. This was very different in that we kind of had this recession happen to us before any of the data told us we were having a recession. And that was a consequence of really having the economy shut down for March and part of April, in which activity across a wide variety of sectors really just stopped. And so basically the economy went into instant recession. And we had no data really to think about, well, what is this going to look like? Right? The data started to trickle in over the last couple of months to sort of tell us how severe this recession has been, how deep it's been. So the unemployment rate, for example, the number of people that are looking for work but can't find a job, soared to almost 15% very quickly. That kind of change just doesn't really happen in the past. And that kind of depth of downturn is very much consistent with what you'd expect from a depression type event. It's really the worst downturn since we've had since the Great Depression. So that's telling us something about just how severe this downturn was. If we look at broader measures of unemployment, unemployment could be high as 20%. When we think about people that are not formally attached to the labor force anymore, for example, or people that have been forced onto part-time work because of the lack of hours due to COVID-19. So that's an even bigger number that just talks about the stress that society is feeling as a result of this downturn. Another place we saw this is in the steep drop in jobs. Over 20 million jobs lost fairly quickly over a couple months as a result of shutting down large portions of the economy. Interestingly, we've started to see that come back a little bit. After the first initial shutdowns ended, we've seen some workers come back to work. So that case started to give hope that maybe this downturn would not necessarily be as long as it could be. Now, I think that gets us into another question: is what's going to be the duration of this downturn? Right? So if it's just a 2-month downturn, a 3-month downturn, that really wouldn't be that bad. In that case, you think of this event as like a hurricane shutting down the economy. Or a snowstorm shutting down the economy, a natural disaster that really causes economic activity to stop. But then when that disaster is over, economic activity pops back up. It's like flipping a light switch in those circumstances. This, unfortunately, is not like flipping a light switch. And that gets us to the problem of how long this downturn is going to last. This is more like slowly turning on a dimmer switch, putting parts of the economy back online, but they're not able to come back online very quickly. That gets us to some concern about how long this protracted period of high unemployment is going to last, and what are the impacts really on families and households as we as we move through that period of high unemployment, and then again, what kind of policies that we can take to mitigate those impacts. So these are a couple of charts. One is retail sales, excluding some volatile components, autos, gas, and building materials, and this is close to what we call core sales. And those started to rebound very quickly. Actually, this data changes so quickly that I can't keep my slides current enough. This actually changed this morning, and we saw another jump in retail sales. Essentially what's going on is that as people have gone back to work, as people have learned to sort of operate around the virus a little bit, they've suddenly started spending a lot more and rebounding spending to where it was, almost to where it was in some cases prior to the downturn. And that's great. That's a good sign that it is possible for us to recover demand fairly quickly, but we're going to have to talk really about what policies are helping support that and whether or not those policies are going to fade out. So the support that we're getting right now is from a couple different forms, both fiscal and monetary policy. From the fiscal perspective, we had two big pieces of policy, actually three big pieces of policy. One is rebates for taxpayers. We also had expanded unemployment insurance, and this has been extremely important. So the idea was that if we were going to shut down the economy, we should try to make families as whole as we can. And so in order to do this, we loosened the restrictions around unemployment insurance and added another $600 a week in unemployment benefits to workers that lost their jobs as a result of the pandemic. This created an enormous amount of support for families as they navigated this crisis, and is a key factor in supporting demand in the economy. And it's also a key factor in supporting other aspects of the economy. So for example, unlike, say, the Great Depression, by having these kinds of support programs, people are still able to cover their fixed costs. People are still able to pay their rent, pay their food, pay their utility bills, and if actually in some cases maybe even get ahead a little bit. That's been a huge, I can't even say how big a support that has been for the economy. That helps us bounce back more quickly and then limit the duration of this downturn and make it something more like a hurricane and less like what we saw in the wake of the last recession, a very protracted period of economic weakness. Another part of the policy response has been the Paycheck Protection Plan. So loans to small businesses in order to convince them that they should have the finances to retain their workers. So that was another part of the government's response to the COVID-19 recession. So all of those things have been extremely important. Now, the problem that we're facing is those things are expected to expire at the end of this month. I think we're mostly concerned in particular about the the enhanced unemployment benefits expiring as we get at the end of July, because those benefits are playing such a large role in supporting demand in the economy. The other reason we're concerned about this is we're now starting to see the second and third order impacts of those initial shutdowns evolve on the economy. So my other chart here on this slide is basically unemployment level for permanent job losses. So early in the downturn, people who lost their jobs thought it was largely a temporary downturn. Basically, as soon as the virus was under control, that we would be able to all go back to work just as we had. That's becoming not the case. Increasingly, we're seeing permanent damage, I should say persistent damage, as a result of these downturns. And so we're seeing that in people reporting that they expect that their job losses were not temporary, but are in fact permanent. And that number began to rise in the last couple of months quite steeply. And you can see, compared to what happened in the last recession, the dark bars around 2007, 2009, we're still not to the level of permanent job losses, but we're moving in the wrong direction. What's going on is some people are not able to go back to work at the end of this month as maybe they had anticipated. Many of our leisure and hospitality establishments, for example, are still operating well under capacity or still shut down, and so you can't return to the job that you had. And also the secondary effects of weak demand through other parts of the economy are causing job losses. Now, the challenge for policymakers is recognizing that as you get into the second half of this year, there's such weak demand for jobs right now that it's preventing people from being able to go back to work. And as a result, there's a real need for both the sustained unemployment insurance benefits and making for people that lost their jobs in the first part of this year that can't get a new job, and then for the newly unemployed that are just losing their jobs now and really need to be sustained through the back half of this year. And I want to emphasize that that's really how we support demand in the economy overall and prevent the spread of the virus from becoming an even bigger problem within the economy. So duration, how long this downturn is going to last, we still don't have a perfect idea. Most economists, I think, are centering around 4 to 5 years before we could return to previous levels of output, previous levels of unemployment, and that's, I think, on the expectation that we have some kind of cure or at least therapeutic treatment for COVID-19 in the near future. The longer that we have the problem with the virus weighing on large portions of the economy, the longer it will take to recover the economy overall. Really this gets to another issue, is that for either depth and duration of this downturn, we really need to be able to control or contain the COVID-19 pandemic. And if we can do that, then we can start growing the economy a little bit more quickly. So then there's the other issue of deflation. Deflation is a general fall in prices. If you take principles of macroeconomics, and many students do, we talk about the three big economic indicators: national output, so we call GDP the sum of all the goods and services produced in a nation during a given year. We talk about unemployment, and we talk about prices. And our concern right now is that the economy has been hit with such a negative demand shock where people just aren't buying enough stuff that we're going to have deflation or falling prices. And this is a bit of a challenge, I think, for people to understand that falling prices are not good and rapidly rising prices are not good. What we try to maintain for the macroeconomy is a fairly stable increase in prices at a very low level. We want the Federal Reserve, the nation's monetary policy setting authority, tries to get inflation to be about 2% a year. So they're trying to get the general price level to be rising about 2% a year. Why not 0%? Why not hold it flat? And one reason is we think maybe inflation is mismeasured, that maybe we're overestimating inflation in many cases, so the actual inflation is a little bit lower than 2%. Another reason is that actually we think that having inflation a little bit above zero creates slightly higher interest rates, which allows more opportunity to lower interest rates when you have an economic downturn and then stimulate the economy. So we aren't looking for negative inflation, we aren't looking for zero inflation, we're looking for very small increases of inflation. So what the concern is that you get into an economic downturn like this, you actually get deflation, where prices are falling. We don't like that, first of all, because it limits the capacity of monetary policy to reduce interest rates. It also has a problem where people might put off future spending. Essentially, we're not going to spend today because I know the prices are going to be 2 or 3% lower tomorrow. That creates weaker economic conditions now. So we've had a couple of months of deflation in this downturn. We're sort of trying to figure out, well, how much will prices fall, or will they stabilize? And they stabilized a little bit in the last month in June, and so that was good news, and I think also indicative of the strength of the policy that we have in place. That absent the fiscal policy, demand would have fallen more, and had demand fallen more, we would have had a harder time stabilizing prices. So we know that at this point, really, whether or not this recession becomes what we call a depression is heavily dependent upon policy outcomes, right? What's going on in Washington, D.C. that's creating additional demand in the economy or preventing deflation? How do those two things interact? The other role that we should talk about that's preventing this recession from getting worse is that of the monetary policy, what the Federal Reserve does. The Federal Reserve, for what generally people think of it as setting interest rates. So they set the interest rate on overnight loans between banks, and that sets the interest rate at other points in the economy. So it will help set longer-term interest rates. It'll help set interest rates for cars, for homes, and typically during a recession we want lower interest rates because that helps stimulate demand and it reduces the cost of people's debt burden. So the Federal Reserve, though, has already lowered interest rates to zero. This is an issue that monetary policymakers across the world are facing, is that the underlying rate of interest, what we call the natural rate of interest, has probably been depressed globally for some time. We first saw that in Japan back in the 1990s, and it really spread across the rest of the globe. So the Federal Reserve lowers interest rates to zero, and then they have other programs that they use to support activity. A lot of the point of these programs is to prevent the financial markets from freezing up and stifling the flow of credit to the rest of the economy. We don't want that because that's something that happened during the Great Depression, where we saw widespread bank and business failures as a result of monetary policy not really acting as forcefully as it should. So the Federal Reserve has been very much engaged, particularly early in the stage of the crisis, to try to stabilize financial markets. One thing that I've learned over time is that people don't entirely appreciate how important it is to stabilize Wall Street. The challenge is once Wall Street starts to fall apart, that feeds back onto Main Street in very negative ways. And that's actually what we saw in 2007, 2009 recession after the housing market crashed, was that the financial market crisis really constricted the flow of credit to the economy, and in that case really added to the downturn as a result of slowing housing activity. So we don't want to recreate that type of event. So the Federal Reserve lowers interest rates to zero. They engage in a number of market activities, such as purchasing a large number of assets, treasury assets. They also purchase mortgage-backed securities. They also initiate a bunch of lending programs. And lending programs are designed to basically jump over any roadblocks that have occurred in the financial markets. By doing this, they greatly stabilize the financial markets. What's very interesting about this downturn relative to the prior two downturns is that those prior two downturns were really financial market shocks that flowed into the real economy and then created the recession. This is a real economy shock that flowed into financial markets, threatened the financial stability, and that process would basically potentially reverberate back into the real economy and make the recession even worse. The Federal Reserve, at least for now, has short-circuited that problem and helped stabilize financial markets, which then prevents that second impact from failing financial markets feeding back into the rest of the economy. So when I look at this data, when I look at how policymakers are acting, it's very evident to me that we have the tools that would prevent this recession from becoming a depression. We have the tools to offset the weakness of demand. We have the tools to stabilize financial markets. It's really just an issue of whether or not we're going to be able to maintain those policy tools going into the back half of this year. So that's where we're focused on. And to give another sense about how important the $600 a week lifeline has been for the economy, this is a graph of real personal income. And we separate this into two parts. The green line here is real personal income excluding transfer payments. So basically excluding or not including payments from the government. So that drops severely as a result of the job losses. People don't have jobs, they don't have income. So very, very sharp drop in income. The blue line includes transfer payments from the government. And you can see that once you include those transfer payments, we've actually had a huge jump in personal income. That's the support that's really helping us weather this historic downturn in jobs. And so, again, the policy implications for dealing with COVID-19 are telling us that fiscal policy works, and we should be doing more of that kind of government spending, or sustaining that government spending, to help us move through the back half of this year and support the economy. I mean, now, even with that, we're going to have to anticipate structural change in the economy. So one of the points that I stress is, okay, even though we have the tools to resolve the broad macroeconomic impacts, that doesn't mean we're not going to have economic impacts at the microeconomic level. So, for example, one of the sectors that's very much damaged by this is food services, restaurants and bars, essentially, but leisure and hospitality more broadly. And those are going to be industries that are probably going to face some pretty significant restructuring going forward, mostly because we just can't we can't create the capacity that those businesses need to survive. So even though we can have the macroeconomy doing okay, that doesn't mean that on the sector or industry level that everything is okay. We're going to see shifts in the economy. Now, for some people, for entrepreneurs, that's going to create opportunities for learning how to grow around the virus. Obviously, there's state and local implications too. I also track the local economy, so this is an index of economic indicators that fell sharply as job losses mounted and other indicators soured. And so what we tend to see is that the state of Oregon follows the national economy in these downturns. So then briefly, a couple last things. How do I interact with the public? I do a number of speaking events. So people ask me to come talk about the economy, how it affects their community, how it affects their businesses. I have a number of newsletters, and also I generate a considerable amount of media exposure by talking with reporters, oftentimes really about financial markets. So the Wall Street Journal, the Financial Times, the New York Times, those kinds of media outlets. And then I also serve on another number of committees with the Oregon Governor's Council of Economic Advisors, and also on the Oregon Public Debt Advisory Commission, in which the organization that basically tracks how much debt is being issued by the state of Oregon and government entities within the state of Oregon, and making sure that that debt is being issued in a responsible way, such that we don't overburden future generations of Oregonians. And then all of this also feeds back into my teaching. So right now on my schedule, I teach a couple of classes. One is called Economics 471, Monetary Theory. So that gets into what the Federal Reserve is doing and why the Federal Reserve is doing it. And also Econ 422, which is economic forecasting. So that is essentially analyzing the data to try to get a sense of where that data is going to head in the future, and that actually has a wide variety of applications, just not from a macroeconomic perspective, but also from a firm perspective, being able to forecast sales. So other classes that I've taught or might teach again in the future, Economics 202, Principles of Macroeconomics, International Finance, and History of Economic Thought, or Evolution of Economic Thought, I think is our technical class name here, where we sort of track through some of the classic thinkers in economics and see how their ideas evolved and created the environment, the intellectual environment that economists work in now. So that concludes my presentation, Cora, and I'm more than happy to take questions.
Thank you so much. And we have plenty of questions for you. I've been tracking on my phone here, and students are asking some really insightful questions. And I think there's a few here. I think returning to some basics, Audrey wants to know, what's the difference between monetary and fiscal policy?
Oh, and I apologize. I should have emphasized that at the start. You know, honestly, Cora, I drink a lot of coffee, and I get to these events and I start talking, and it just doesn't stop. So monetary versus fiscal policy. Monetary policy is what the Federal Reserve does, which is managing the nation's money supply. So here we're thinking about setting interest rates. How does the amount of money in the economy interact with financial markets? That aspect of policy. Fiscal policy is really what Congress does. So that's government spending and taxes. So that's the breakdown. And I apologize. I should have made that more clear at the front end of this.
No, it's fine. This is a good chance to kind of set the bar, right? Becca wants to know, what's an economic depression and how can we avoid it?
So that's a good question. I don't know if we have a real definition of economic depression, and you know, my analysis is that it has to be very deep, and it has to be fairly long, also, I think you probably have to have some deflation, which really reflects the weakness of the economy. Really, how we can avoid that is, first of all, by getting the pandemic under control as quickly as possible. That's a huge part of this. There's not really a trade-off between the pandemic and economic activity. Those two things are just interrelated. So getting the pandemic under control is the first thing. Fiscal policy, so creating support for households so that they're able to basically make their rent, make their mortgage payments, buy their food. Compensate them for their job losses. And also, again, monetary policy, holding interest rates low, making sure financial markets are functioning effectively. So those are the broad policy options really available to us to prevent this from becoming a depression. We have an enormous amount of experience from the Great Depression itself, from policy, from recessions afterwards. The last recession, for example, we understand what needs to be done. It's just, do we have the political will to do it?
Yeah. So this leads into the next question from Lucy. How long will the government be able to sustain these policies that are aiding people in the economy?
Well, so that's an excellent question. The government is racking up deficit spending at a fairly rapid pace. Mm-hmm. And we've always been worried about what happens if the government racks up too much deficit spending, right? Will there be a financial crisis as a result of that? So a couple points on this. The U.S. government really can't go bankrupt. The issue that people sometimes forget is we actually print the currency that the government's debt is denominated in. Literally, at the very worst case scenarios, you could think of, well, okay, you have a government bond, we'll give you, print off $1,000 to replace that government bond. So you can't have a true bankruptcy like that. What you tend to get is inflation. Essentially, what goes on is the government spends more, just trying to buy too many goods and services relative to what the economy can produce. Mm-hmm. And that's where you start to worry, well, okay, has the government spent too much money? Essentially, do we have to raise taxes or cut back on the spending to deal with this deficit spending? And I think what you're really looking for there is inflation rising to an unsustainable pace? That's your real metric, that you're stressing the real resources of the economy, and you've gone too far with fiscal policy, and you need to rethink really what the mix of spending and taxes are. Now, I will say, again, these are lessons that we learned from Japan over the last 2 decades. Japan has pushed forward a massive amount of fiscal stimulus, deficit spending over the last 20 years, and it has not created inflationary pressures. So what we've learned, I think, in the last 20 years is that we might have been underestimating the capacity of the economy. And that underestimating the capacity of the economy might have led to actually higher unemployment, and lower wages over the last 20 years than we really should have had. But this is I think an issue of ongoing research. Exactly, we don't know exactly where the limits are. I can just tell you that we haven't hit those limits, and I see that in the inflation data in the last 20 years.
Thank you for that. So one of the students wants to know, can you talk about research you are doing with undergraduates in this upcoming year?
So this upcoming year is obviously a bit of a challenge. Trying to figure out how you do the face-to-face research. What tends to happen is I end up working with students that are in their final year of school. So students that tend to come to me and ask, can we work on a research project together? So for example, in the spring term, I had a student who was basically following through and making a record of what are the economic implications, or what are the policy reactions to the COVID-19 pandemic. And so that research then translated into an honors project for them. So that tends to be the kinds of work that I tend to do with students is, all right, so you are looking for an honors project, you're looking for a paper or something you're interested in, can I give you some guidance in managing that process? And that's typically how it works in our department.
Fantastic, thank you. Gabriella wants to know, how do you see the upcoming presidential election affecting the economy?
So there's lots of different avenues there. So for example, it doesn't make sense going into election year for an incumbent president and the majority party to let the economy fall apart. Right? So that should say that at the next couple of weeks, we get a fairly significant stimulus package to support the economy, to continue these unemployment benefits, for example, or at least a portion of these unemployment benefits going forward. There's been some debate whether they were actually too generous, because some people were making more on unemployment than they were during their regular job. So that's one way this can influence us. And then the other way is, to what extent does policy change after the election in such a way that either supportive or not supportive of the economy? So are you going to have more fiscal stimulus, for example? Would it be easier to do under a President Biden than a President Trump? Will it be easier to control the pandemic under President Biden versus President Trump? Those are really where you look into next year and think about, well, what are going to be the implications of this election on the economy?
Perfect, thank you. Emily wants to know, do you think this economic hardship will force leaders to create permanent solutions to avoid this problem from occurring again, or with or without a pandemic?
So there's a number of people that have been pushing for permanent types of fiscal stimulus solutions so that we don't need to wait for Congress to act before addressing the needs of the unemployed, for example. And I'm hopeful that the success, I think, of this initial stimulus package that we saw with the CARES Act, with the unemployment benefits and the Paycheck Protection Plan, that success can be built on to create more permanent structures to support the economy. A small step in that direction would be that with this next aid package that Congress is working on, if they could tie the duration of that package to economic outcomes. So instead of saying it's going to last for 6 weeks or 12 weeks, let's say it lasts until unemployment has fallen to 6%, or say the benefits will be at this level at 100% of salary until unemployment's fallen to 8%, and then it's going to be 90% of salary until unemployment's fallen to 7%. Something along those lines that would sort of take the timeline out of the policy and create more permanent structures. And you could do this on the front end too, and say, okay, when the unemployment rises 0.5%, these programs automatically kick in. And I'm hopeful that the next generation of economists and policymakers will craft those kinds of solutions because they would create a much more stable economy than what we have right now.
Excellent. Excuse me. Mira has an excellent question, future thinker here, Mira. What is the predicted impact on the job market for us leaving college in 2024?
Oh, well, that is a very good question, and one you don't want to know. Well, if
big if
everything falls into place. And as I said, that if economists, and many economists are shooting for 4 to 5 years out as being the time period in which we can recover from this downturn, that would mean that unemployment rates were very low when you graduated from college in 2024, and would mean that there would be a very good job market for you, for this class. So I am hopeful that the people entering college now will come out with a lot of opportunities in 4 years. Essentially what our 2019 graduates experienced. The graduates left school last year. They entered into a very strong job market. Unfortunately, obviously, everyone graduating this year has entered into a weak job market, which I can't stress enough has some possible lifetime consequences for that generation. That if your first job is hard to get and has a lower salary, that will maybe weigh on your salary and job employment opportunities throughout your career. So I think now is the time to be starting the college education because of exactly those issues, is that we should be in a better position when you graduate in 4 years.
Thank you. Let's see, I've got several questions. Sophie wants to know, how can UO students of any major get involved in economic research regarding the COVID-19 pandemic?
Okay, so how do you get involved in economic research? So traditionally, well, I guess I'll back this up, is that there's going to be a lot of different avenues within the university for doing that. And I sometimes, you sometimes get parochial, you think about your own department, but there's avenues for non-economics majors too. So an economics major would be taking econ classes, be exposed to economics professors, and usually in that mechanism would create the relationships that generate that kind of research that I was talking about earlier, where students will come and say, I would like to work on a research project, and you work with them on that project. We also in economics have a community issues class where students work in groups on community-based projects. And I would expect that as the next year or two evolves, that those become more COVID-related or dealing with the outcomes of the pandemic. So that's one place. The business school will also have faculty that are working on COVID-19 related issues. The Institute for Policy Research and Engagement, another part of campus, is actively thinking about how local economies recover from COVID. So there's actually a wide number of people throughout the university working on COVID-related projects right now. So even if you're not an econ major, there are going to be opportunities to plug into that in other parts of the university.
Thank you. We had one from a student, and let me go find it. Sam, this is one that I thought was a really fun question maybe to end on here today. Sam wants to know, have you heard about the national coin shortage, and how can you explain that?
So I have heard about the national coin shortage, and it's something that I don't have a great explanation for as to why suddenly we're not able to get coins out into the public as much as we did. Part of it is clearly, people must be using more cash, and we're not being able to create the capacity to move the coins. But honestly, this is one topic that has really fallen off my radar, other than having heard about it. So many people are using debit and credit cards that it seems like that this shouldn't be a problem, but
it's like toilet paper, though. Maybe they're hoarding it.
I'm sorry, I didn't hear that.
Maybe they're hoarding it like the toilet paper.
Maybe they're hoarding it. But no, this one has fallen off my radar a little bit.
All right. Well, that is all the time we have this morning. We do have a number of questions in the Q&A, and we'll be following up with those students and getting them the answers that they need. And hopefully Professor Dewey will be part of that follow-up with us. For you students, please be sure that you complete the short reflection on this session in the community.uoregon.edu course. If you have questions about that, we encourage you to text your SOSer, in your flock leader, and they can help you navigate the community course. This helps us track your attendance for these sessions, so please be sure that you do that anytime you watch one of these, whether it's live or you're watching it after the fact. If you have additional questions related to this program or anything related to introduction, please visit our website at orientation.uoregon.edu, or you can email us at orientation@uoregon.edu, and you can also text our office at 541-346-1159. Thank you so much for your time today, and to you, Dr. Dewey, thank you.
My pleasure. Thank you.